Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me to discuss the Fed, debt, and inflation, we have Steve Ricchiuto, Chief U.S. Economist with Mizuho Americas. Steve, it's great to have you with us. Welcome back to Trade Talks.
Thank you very much, Jill. How are you doing?
Doing great. And the United States has taken unprecedented fiscal steps in the face of COVID-19. Now, with the Fed monetizing all of this debt, is that concerning to you?
Well, for a lot of people, it is a concern. For me, it's not. The difference between my interpretation and everybody else's interpretation is where we are within the concepts of excess supply versus excess demand. Throughout most of the post-war period, the U.S. economy was involved in a world of excess demand. So monetizing the debt would be inflationary. Keeping the foot on the accelerator would be inflationary. In a world of excess supply, just the opposite is true. Our biggest fear is deflation. And what the Fed is doing by expanding its balance sheet is keeping us from moving into that deflation trap, where Japan has been stuck in that trap for 30 years, since 1990. And Europe is rapidly approaching that trap as we speak. And that's a critical distinction between what's going on here versus what's going on overseas.
Are you seeing anything in the debt markets? And then also let's discuss the impact to the dollar, because that's really been, a noticeable move at this point.
Yeah, the debt market perception of this inflationary environment, that seems to be a fear that a lot of people has. The markets are answering it that they agree more with me. The long-term trend in where the TIPS market is telling us inflation expectations are moving lower. And more importantly, when we look at the CPI, and we split it out between its domestic constructs and its overseas or tradable goods constructs, which are done very nicely for us by the Atlanta Fed. They have this measure called the sticky and the flexible components of CPI. The sticky components of the CPI are running still in positive territory, around 1.5%, while the tradable goods portion, which are reflecting global excess supply, have dipped way down into the negative territory. And this is why a weaker currency is actually good, because it immunizes the U.S. economy from global deflationary pressures.
Now, what about rate expectations into the end of the year in 2021? I can't imagine that we'll see any movement there.
Well, at the front end of the curve, you're 100% correct. I mean, the Fed has basically told us they're locked in at this near zero interest rate policy for an incredibly long period of time, and I agree with them on that. At the longer end of the curve, assuming that people become more comfortable with the notion that the recovery we're in right now is sustainable, and that we are going to move from a recovery into a expansionary phase, and the dollar keeps on moving lower, which I hope it does do, because the Fed is going to continue to remain accommodative and stimulative and driving up its balance sheet, then we could actually see some of the long rates moving back up again. And my end of the year number for the 10-year note is 1%. And my middle of 2021 is 1.5%. So I expect to see some steepening in the curve between the very front end and the very long end of the curve as we go forward.
Steve, let's talk about the market reaction for a moment, because what we're seeing take place in the markets is very different than what we're seeing take place in the economy. Tens of millions of people are out of work. Consumer spending is down, which of course impacts GDP, as we saw in the latest release. Do you think there really is a disconnect there? Can the economy feasibly play catch up to the market?
Well, over the long term, that will happen. The thing you have to understand about the markets is the markets are forward discounting. The economic data is coincident at best, lagging more likely than not, and very few real leading indicators, that we can rely on. The markets, however, are processing forward earnings expectations. They're processing expectations of forward inflation rates. And because the markets are being more forward-looking, the markets are discounting what I think is going to happen, which is a sustained move from recession to recovery into expansion, led by a coordinated monetary fiscal policy approach, which is something we haven't seen since the 1960s in the U.S. economy. And that will then lead to a bit more inflation and a bit broader improvement in the economy as we go forward. I mean, my year-over-year growth numbers for GDP have us back to zero by the second quarter of next year. Now, that doesn't mean the level of GDP is back to where it was on a pre-crisis basis, but it's getting very, very close to it at that juncture.
All right, Steve, thanks for joining us on Trade Talks.
My pleasure. Thanks for having me.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.